let's do a cash sale, huh? So let's sell $60,000 worth of services for cash. Debit way. Cash. These are ridiculously easy now, aren't they? 60,000. Credit. That's old. Services. What are you going to do?
Service revenue.
Service revenue. Yeah. Okay. You guys are never going to miss these again, are you? Okay. You haven't already stopped. And then you'll stop. Okay. All right. So that's a cash sale. You're done, right? The deal's done. It's over, right? You sold them the services and they paid you for them, right? The assets are increased and the revenue's increased and equity's increased, right? Net income's increased, equity's increased. Sure. Okay. So let's sell some on account instead. Let's sell 100,000 on account. Okay. So this is our first transaction with sales on account. Okay. So what would you do? Services sold on account, $100,000. Debit what? Accounts receivable, absolutely. Okay, nothing to it. 100,000. Credit what? Services. What do you do? You don't have to think about this, do you? Someone answer me. What is it? Service revenue. Yeah, it's too easy to answer, even, isn't it, at this point? And that's where we want to be. It's just what it is. Okay, then what do you suppose happens? Customers pay us. Let's say we collect, I don't know, let's collect 70,000 of it. What do we collect?
70,000
Cash, of course. People, account receivable, people are going to pay us cash, right? Okay, so we receive cash, debit, cash. You like that? What did I say, 70? There's just nothing to this, you guys. What don't I have anymore? I don't have more service revenue, do I? I didn't collect some unearned revenue, did I? What is it? They're paying off the receivable. I don't have it anymore. The asset's gone. What do you do to it? Credit. Absolutely. There is no one here that can't do that, is there? I mean, this is just nothing, right? Okay, so now here's the deal. When do you want to recognize the revenue? Recognize means put it on your income statement. Recognize, record it, recognize. When do you want to recognize it? When you earn it. When do you want to recognize the cash coming in? When you get the cash. Might those be at different times? Sure, you guys know about deferrals and accruals, don't you? They can be at different times. That's all that's happening here, right? Okay, but I want to get that revenue recognized because I earned it. How much revenue have they recognized this particular month, say? That's a month. 160. You bet. How much cash have they collected? 130. How much have they not collected that they sold? 30, of course. And what's that going to be the balance in? What account? Accounts receivable. What is accounts receivable? It's an asset that represents what your customers owe you. All the open invoices, you give a customer an invoice, all the open invoices added up is going to be accounts receivable, isn't it? The balance that each one of your customers owes you, if you have 100 customers and you add up all those balances, guess what? It has to add up to 30,000 that's in the general ledger. Because that's what you're going to put on your balance sheet. You're going to tell your shareholders that's how much you owe to us. So it really ought to be, don't you think? Okay. Take it one step further. Are you going to collect all of it? When you decide to grant credit, you are deciding to accept what, probably? You're accepting the risk that people will not pay you. Should we estimate how much we think we're not going to get paid? Because you know what? We're pretty good at estimating this. If you sell this to the general public and you give them time to pay, you've got a lot. If you sell only to top companies, right? Big companies that are really profitable, really healthy, probably you won't have very much that does not get paid to you. But when you go bankrupt and you not get paid, right? Okay? Or they could disagree with you, not think the product is all that good, and then not pay you. There could be things happening even then, huh? So when you're selling and you're granting credit, what are you accepting, of course? Bad debts. You're going to get some. Should we estimate it and record it? When are you recording the revenue, you guys? When it's earned. When should you record all the costs associated with getting the revenue? Matching, right? When should we do it? When you deliver the goods or services, right? You've earned the revenue, but what should you record in the same accounting period so that we get the right net income? All the costs associated with getting that revenue should be in the same period. So here's the idea. We are going to estimate bad debts and record them in the same accounting period that we recorded the revenues. Does that make sense? You don't want to wait and record the bad debt expense and you find out that it's bad. How long is that going to take? Anyway, try and collect it for a year probably, huh? Something like that. I give you 30 days to pay. I probably won't give up for about a year. I'll keep sending them letters and calling them up and asking them to pay me, and then when I finally give up, it might be a year later or more. So by the time I know I'm not getting paid, it's a different accounting period. That's the idea? And I would move the expense the next year instead of being in this year. When do we want to record the expense? When we incur it. So yeah, there are all kinds of expenses we estimate. This is just one of them. Okay? So we're going to use this allowance method. This allowance for doubtful accounts. This allowance method. What's the allowance? It's going to represent the portion of the accounts receivable we expect never to get. When you communicate with your shareholders, do they want to know how much people owe you or how much people are going to pay you? What can they spend? How much is owed to you or how much they're going to pay you? Well, pay you personally. What if I owed you $10,000, but you know there's no way in the world I'm going to give you more than $1,000? What do you think your assets really worth? $1,000, of course. Okay, so if I've got 30,000 accounts receivable here and I think I'm never going to see 1,000 of it, what do you think? Really, it's only worth what, guys? The 29,000 I'm going to get. And that's what we want to reflect in the balance sheet. Make sense? Right? And if I have this 130, what do we have, 160,000 in sales? 60 plus 100? If I have 160,000 in sales, and I think I'm never going to see 2,000 of it, what do you think? What did it really sell? Probably really sold the difference, 158. But I'm not going to reduce my sales. I'm going to record bad sales expense instead. It's an expense of getting the sale. Does everybody agree? By the way, why do you grant anybody credit? Because you love them? Oh, you don't need to pay me now. You can pay me a month from now. Because you're such a good friend. Is that what's going on here? You don't even know them, right? What's the deal? They're your customer. You're really know them, right? Personally, for business, buying from the business, typically. What's the deal?
That's how you get them to buy.
You get them to buy more. Yeah. One company grants you credit, another one doesn't. You might have cash right now, and you need goods. What do you do? What are the services? Buy from the one that grants credit. So then you lose your sales to people who do grant credit if you don't. If you're in an industry that grants credit. Have you ever noticed that fast food joints that really don't grant you credit? You can't say, okay, I'll come by next week and pay you. Right? One, they're afraid they'll never find you. Two, they're selling you stuff that makes you ill. That's right after you never pay for it, right? Okay? So you certainly forget about owing it to them. Right? With me, guys? Okay? They don't take your credit card, but they're not going to give you credit. The bank is. Right? The bank's going to credit. They're giving you money. That's a discount. Okay? Small business. Yeah?
Have a way of giving you credit.
Yeah. To have a way of giving you credit. It's just a real unofficial and not a good idea way. Like run a tab for somebody, usually in a bar. Okay? You run a tab for somebody, or gambling. You run a tab for somebody, how are you going to collect money? Pretty tough. Yeah. So. But sometimes people do that. Sure. Okay. All in the account receivable is a custom for it. Okay, sure. Okay, so let's go through the accounts here with this. What happened, you guys? I have got, let's just do the account receivable. Well, let's do the accounts receivable and the sales. Let's do both. Let's see, what did I do? Service revenue or sales? It's product of sales, service revenue, if it's services, of course. Okay, I put 60,000 in there from this one, didn't I? This is just posting, isn't it? You guys know how to do this. This is 100. I got 160 in there. And then I have accounts receivable with a debit of 100. Let's say it's our first month of operation, so it's 0, right? First year. Okay, and then we take out 70. So what's my balance right now? 30 here. And it's 160 here. Okay? Now there's two ways that we can handle this allowance for doubtful accounts. This allowance method of accounting for bad debts. Well, that's the thing. Okay, anyway, I don't know what I did there. We're going to play some music. Okay, anyway. I could either estimate what portion of these receivables I'm never going to collect, or I could estimate what portion of the sales I'm never going to collect. But you know what? I already collected the 60 that I sold for cash, didn't I? So I probably only worry about the credit sales. So here's my credit sales, right? On account sales is what I mean, okay? And here's my balance in accounts receivable, right? Two different ways that I could do this. And the author shows you this, and then there are problems that do this. on the practice quiz and practice test I gave you, I have you do it. I'm going to have you do it, okay? Have you do it on quizzes and tests and final. Absolutely. Okay, so here's the deal. I could either estimate how much of the account receivable I'm never going to see, or I could estimate how much of the sales I'm never going to see. Now, what I'm going to do is I am going to debit bad debt expense. That's a B. Bad debt expense. And I'm going to credit allowance for doubtful accounts. Right? By the way, what kind of an account is bad debt expense? Every time we have a new account, you ought to ask yourself, what is it? Bad debt expense? What do you think it is? Expense, of course. What financial statement are you going to put it on? Not directly equity, into income statement, which will change retained earnings and equity. Yeah, okay, it's going to be on the income statement, reducing net income in there. Okay, sure. What's allowance for doubtful accounts? Contra asset. It's got a normal credit balance. It's contra, right? Increase with the credit, reduce with the debit. Everybody agree? Contra asset. What account does it go with, of course? Accounts receivable. Okay? Everybody agree? Allowance for doubtful accounts is what? It is my estimate of the accounts receivable I am never going to collect. Got it? That's all that is. Okay? And bad debt expense, what's that? It's going to be a debit. What is it? Goes on my income statement. It's a cost of getting my revenues. It's an expense. It's my estimate of the credit sales I am never going to collect. Now let's do this again. This is what's going to hang you up and drive you crazy maybe a little bit until you get it. Okay? So get it right from the beginning. Right from the beginning. What is allowance for doubtful accounts? Contra assets. It is the portion of the accounts receivable you expect never to collect. So if I base my bad debt estimate on accounts receivable, what am I estimating? The portion of the receivables I'm never going to collect. Got it? So guess what that'll be? That'll be the balance I want to have on my balance sheet in what? Allowance for doubtful accounts. On my balance sheet, I am going to show accounts receivable less the allowance for doubtful accounts. And that difference is going to be net realizable accounts receivable. What does realizable mean? I'm going to get the money. I'm going to get the cash. Realization is getting the cash. Got it? Okay. So that debit balance in accounts receivable less the credit balance in the allowance is going to be the amount of receivables I expect to collect. Everybody agree with that? So all these things are. It's just definitional. Okay. What's bad debt expense? It's a cost I incurred, I granted credit. It's my estimate of the cost I incurred to get additional sales, right? What portion, if I take a percent then of my credit sales, I estimate, say that 1% of my credit sales I'm never going to get, right? In this case, that'd be 1,000. I estimate that's what I'm never going to collect, okay, from my customers. That's pretty good if it's only 1%, by the way. Okay? I estimate that 1% I'm never going to see. Okay? What account did I just estimate? What would that 1,000 be? And I'm estimating it based on sales. It's on the income statement. What's on the income statement that represents the portion of the sales you're never going to collect? Bad debt expense. That's what it is. And if you know that, you have made. Allowance for doubtful accounts is the portion of receivables you're never going to collect. Goes in the balance. Bad debt expense is the portion of sales you're never going to collect. Goes in the income statement. That's it. Okay? So this gets real easy then. This is going to be an area where you'll either get it or not. It's just horrible. It's just horrible. People just nail this, right? Just, boom, it's obvious what it is. And they just fly right through it. And others will just go crazy and write down different, all kinds of accounts pulled out of here, and different dollar amounts pulled out of here. Work on this thing. It's small, you guys, but you got to figure out how it works, okay? It's just one small problem, really, okay, on how to handle allowance for doubtful accounts. All right, so let's do it two different ways. First, let's say we are going to allow, let's make up a number. Let's say we think we are never going to see 8% of our accounts receivable. Let's make it 8%. Okay, so I think my estimate is going to be based on 8% of accounts receivable. What am I estimating if I use 8% of accounts receivable? Which account am I estimating? Bad debt expense or allowance for doubtful accounts? Allowance for doubtful accounts, right? The allowance is the portion of the receivables you're never going to collect. Okay, right now I've got nothing in the allowance because it's our first year, okay? And you tell me what I need to do. What do I want the allowance to be? $2,400. Does everybody agree? I'm going to take 8% times that 30,000, right? Everybody see it? And I want this to be $2,400. We'll add the zeros from now on. Okay, these are in thousands, right? 2,400, I'd like it to be. It is nothing right now. Guess what I'm going to do? This adjustment is so hard. It's nothing. You'd like it to be 2,400? Aren't you glad you know how to do adjusting journal entries? What do you want to do? You got it. That's it. Ta-da! We are brilliant. Okay? So the adjustment is just really easy. And what do you debit, everybody? What do you have to debit? You have no choice. Your debits have to equal your credits. You're forced to debit bad debt expense for the 2,400. Okay? So here's the deal. You can either have the allowance where you want it to be, or you can have bad debt expense where you want it to be, or I guess you could average in between the two of them. But you're not going to get both of them where you want them to be typically. Got the idea? So you base your estimate on one or the other, or work out something estimate you can live with. Okay, so what's bad debt expense going to be if it starts at nothing and you put 2,400 in it? It's going to be 2,400. Okay? Everybody got it? Now that's just going to be the first year. Because what's going to happen in the next year? What do you do at the end of every single year? You close your books. Which account are you going to close? Allowance for doubtful accounts or bad debt expense? Bad debt expense. Why? It's an expense account. It's nominal. It's temporary. Income statement. What about allowance for doubtful accounts? No, my assets don't go away because I start a new year. I don't close it. Ah, so that 2,400 is going to stay there. This one's going to go to zero when I close the books, huh? Okay, well, let's do the other approach to this, and then we'll do a second year, okay? This was a really good day to show up, by the way. A good day to show up. All right, let's say instead of it being an S, this is or. It's one way or the other, right? You wouldn't do both in the same company in the same period. You can't. So, or we do it this way, okay? I'm going to debit bad debt expense still. Everybody notice this? The journal entry, the debit, and the credit are still the same. It's always to replenish the bad debt, the allowance for doubtful accounts, and to record bad debt expense, right? To replenish the allowance, bring it up to where you want it to be. And to record the bad debt expense. It's always debit bad debt expense, credit allowance for doubtful accounts. Please don't give me different entries on different ways of doing it, right? Different estimates. It's ridiculous. You don't have to change the accounts all around. It's always what? I want to record the bad debt expense, debit bad debt expense. I want to increase the allowance, credit the allowance. Got it? Okay, it's always that. It's just we're going to change the estimate of how big the number's going to be if we use a different method, okay? Or if the numbers change. Everybody got that? That'll pay off for being here today. Just keep yourself straight on that, okay? All right, plus the idea, what does bad debt expense represent? The portion of the sales you're never going to collect. Goes on the income statement. What does allowance for doubtful accounts represent? The portion of the receivables you're never going to collect. It goes on the balance sheet. Yeah, you keep those together, right? And you keep this journal entry, debit, bad debt expense, credit allowance, it's going to fall in place, okay? It's going to work, all right? And it'll make sense when you're done working with it a little bit. So let's say that, what were our sales? 100,000 I had up there, is that right, guys? I had 100,000 were the credit sales. We'll just do it on credit sales, okay? Usually I'll just give you credit sales. I won't have any cash ones. But it'd always be just on the credit sales. Why do we do that? Because the cash sales are already collected. You can't have that expense on those, right? You wouldn't have it, right? You don't need an allowance for that. So let's say instead, let's see, it's 100,000. Let's say I think it's 3%. I am never going to collect. My estimate is 3% of credit sales, on-account sales, right? Everybody's staying with me on what this stuff is, all right? Holler if you don't. Okay? So what were my credit sales? 100,000. What's 3% of it? 3,000. Which account do you want to be 3,000 now? Okay, here we go. It's going to be the allowance for doubtful accounts. Yeah, it's a different way of doing it. Now, just another example. One is I took a percent of receivables. The other one is I'm taking a percent of sales. Two different ways of doing it, okay? But yes, it's another example. Absolutely. Okay? So it's or. You see this or here? It's or. I either do this up here, right? That's with the 8% of accounts receivable. That's a great question. 3% of credit sales down here. Okay, we'll do it a different way, won't we? So what do I want to do? What do I want? I've got allowance with nothing at this point, right? It's my first year. I've got bad debt expense with nothing in it if it's my first year. What did I just calculate? When I take 3% of those credit sales, of those 100,000 credit sales, I get $3,000, don't I? What account do you want to be 3,000, you guys? Bad debt expense. I am going to make bad debt expense be $3,000. How do I make that happen? Debit it for 3,000. Adjusting entries are so much fun, huh? It's just so easy. Once you know where you're at and where you want to be, it's pretty easy to determine what you have to do to get there, right? Debit bad debt expense 3,000, guys. What am I going to be forced to credit the allowance for? 3,000. Okay. Now it looks like, gee, Keith, you're making an awful big deal out of this because you end up with the same balance in both accounts, huh? Only the first year. Only the first year. Because what are you going to do? Regardless of which one of these approaches you take, what are you going to do the very first millisecond of the new year? Close those books, or the last millisecond of last year, however you want to do it, right after you do your financial statements, okay? Before you start posting the second year, the next year, right? Following years. What are you going to close? Bad debt expense goes to nothing, huh? And what happens? That $2,400 stays there in the allowance account. Got the idea? What's going to happen here? This $3,000 gets closed, doesn't it? You guys with me? Goes to nothing in bad debt expense, but the allowance of $3,000 would stay there and roll forward into the next year. Okay? So this is the first step. This is called, when you debit bad debt expense credit allowance, that's called replenishing the allowance or recording bad debt expense. It does both, doesn't it? Okay? All right. So let's expand our example a little. Okay? I said my estimate is 3% of credit sales, and credit sales were 100. I think a couple of you came in a few minutes later. I had a cash sale up here, right? The first one. I had a credit sale, the second one. But you'd only base your allowance on the credit sale. Does that make sense? Because you don't have any bad debts from the cash sale. Unless they wrote you bad checks, I guess. Okay, it's possible, isn't it? All right, gang. So let's sort of... And what happened there? Can you give me one? Okay, don't give me one. Add a page. And then let's do this then. Extend the page. Okay. All right. So let's use sort of our same example. And we'll go forward from there. Okay? So I've got accounts receivable. What did I have? 30,000 left. So we roll forward. And the allowance, let's use the one where I had 3,000. Okay? Let's just say it was 3,000. Okay? I guess that'd be 10% of receivables, wouldn't it? Okay? So let's leave it at that. Okay? And then let's say I have, well, I'm going to need credit sales again, aren't I? Darn it. Okay, let's have service revenue here. This will be a good one to go back and look at it too when you're getting ready, when you're studying this stuff. Pound through it again. Okay, what would be the balance of service revenue when I started a year? 0. We closed the books. Excellent. Bad debt expense? 0. We closed the books. Okay. So now let's do another year, huh? Okay? Let's say that we sell on account 120,000, okay? There's no cash sales this time, just 120,000 credit sales. Debit what? Yeah, I'll have you actually do this. I know I already tested you on this and quizzed you on it. I'm going to do it again, okay? You get more chances, okay? You should be, and you should be getting to a point where that stuff just happens, okay? I get all those points. It's just the new stuff causes you a little pain, maybe, okay, until you get it down. So what did I say, 120? And what do you want to credit, of course? I sold them services. Yeah, everything. Excellent. Repetition really pays off, you guys. And I think that's maybe what you did to yourselves. Because you did it once, thought you knew it, and then couldn't do it. We all do that, right? Try pitching a baseball game that way. Watch a video and then get out there on the mound. Right? Watch a video of somebody great doing it. I've seen really great pitchers pitch. I couldn't put a ball across the plate, and I like to pin it on. I've seen a lot of them pitch. I've seen some really wonderful ones pitch in person. I'm amazed at what they can do. Right? Doesn't do you any good though, right? Just entertaining. So make sure you can do it, okay, guys? Service revenue, 120,000. Did you see the Reds have one of the best pitchers in baseball? And they're one of the worst teams in baseball. Isn't that terrible? 19 wins now. Yeah, what a shame. Anyway, so they'll probably lose him. Anyway, so 120, we'd have a service revenue. All right, and then let's say that we collect, I don't know, let's collect $110,000, okay? Some of that would be collecting last year's accounts receivable, and some of it would be collecting from this year's sales. What do you bet, right? Well, let's say we collect 110. What would you do, guys? Debit what? Cash. 110, right? Excellent. Credit? Accounts receivable. We can do this in our sleep. Okay. But there's one other thing happens. Now it's been a long time since some of those people that owed us $30,000 at the end of last year, since they bought the stuff from us. Some of them bought it really early in the year last year, still haven't paid us. Got the idea? And I start realizing, these guys are never paying us. And I finally decide to give up. I keep trying to collect those receivables, and I finally give up, okay? Let's say I give up on $24,000 worth. What would I do? Now, watch this carefully. 24,000 of this 30,000 I expect never to get. And some of it could be of the other 120 that I sold this year, right? Some of it could be those two. But I'm giving up on $24,000. But watch this. I'm going to take it out of accounts receivable because I'm going to say they don't owe it to me anymore because I don't expect to collect. Got it? I'm going to take it out of it. But also, I'm going to take, did I say 24,000? 2,400. 24,000, we'd have a big problem seeing as we only have allowance of 3. Let's say 2,400. I'm giving up on 2,400. I apologize. Everybody got it? I'm giving up on 2,400. So 2,400 of that 30,000 I'm never going to see. Okay? So I'm going to take it out of it with a credit. Does that make sense? So what I'm going to do, this is going to be a write-off entry, right? I'm going to write it off. I'm writing off the bad debts, right? I'm writing off the accounts. What I'll do is I'll credit accounts receivable, taking the portion I want to give up on, write off, right, by 2,400. So I'm going to take that out of here. Now, does that part make sense to you? If you're going to give up, should you take them out of accounts receivable? Yeah. Why tell people they owe it to you and then you're never going to collect it, right? But here's the deal. You made an estimate last year of how much was not going to be paid to you. You estimated 3,000, right, guys? You did. You debited bad debt expense and you credited allowance. So what's happening now? I'm finding 2,400 of the 3,000. What should I do? Yeah, debit my allowance, reduce it. Is this making sense? Have it make sense. Don't memorize it, or you will write down garbage on your quiz and test and final. You'll have some account that has something to do with receivables and sales and bad debts and allowance, and it'll be some number that you pulled somewhere out of the air, and you write down a bunch of garbage. And I'll give you 0 points for it. And then you'll feel bad. What do we need to do? Figure out what you're doing. Think about what you're doing. What's happening? Does it make sense that if I'm giving up on the receivable, I credit the receivable? Does it make sense that if I found some of the allowance, I debit it, getting rid of it? Just common sense now. If you understand the business transactions, just write it down. So what do I want to do? I want to get rid of 2,400 of this, don't I? Are you guys with me on this now? Making sense. Okay? Debit allowance for doubtful accounts for that $2,400. Right? And we're there. We did the write-off. Everybody see what's going on? So now what we do is, let's say we're at the end of the year now, okay? By the way, you could be writing them off all during the year. As soon as you decide an account's bad, you write it off. Okay? It's fine. All right? But here we are at the end of the year. That was all our sales and all our cash receipts for a whole year. Okay? Keep life simple. What's my balance in accounts receivable? 37.6. Okay. What's my balance in the allowance? 600. Okay. So now what would I want to do? I'm at the end of the year. People owe me $37,600. Everybody see that? And I have an allowance of $600 in it. Is that enough? Seeing as last year they owed me $30,000, right? And I had a $3,000 allowance, and $2,400 was what I used up during the year. Still $600 I haven't written off. Do you think $600 is enough for $37,600? I don't. $3,000 apparently was enough for $30,000, though, wasn't it? Okay? So you know what we're going to need to do? Well, maybe you don't know what we need to do. Think about what we need to do. What do I want to show on my balance sheet? I want to show the amount that's owed to me, $37,600. And then I want to subtract it from that what? My estimate of how much I'm never going to get paid. What's that going to be? The balance in the allowance. Do you think 600 is enough for that estimate? I don't. I think it ought to be at least 3,000, don't you? Maybe bigger. You got the idea? I'm going to estimate how big it needs to be. And I'm going to increase it from 600 up to however big I think it ought to be now. Okay? I want to know, how big should this number be? And what is that estimate? It's my estimate of what portion of the $37,600 I'm never going to collect, right? So I can show on my balance sheet accounts receivable of $37,600 less the allowance for doubtful accounts. Sound good? That represents the portion of those I expect never to collect, and that's going to give me my net accounts receivable. What was my net accounts receivable at the end of last year? 30,000 less 3,000 is 27,000. You guys agree with that? What do I want to show on my income statement? Certainly I'm going to have the sales at 120 on my income statement, but I don't think I'm going to collect all that, so what do I want on there? I want an estimate of how much I'm not going to collect as bad debt expense. Does that make sense? Just like we did on the last examples, huh? This is just continuing into another year. Okay, there's two ways we can do this bad debt thing, isn't there? Okay, let's try it two different ways. Okay? First, let's do, what did I say it was? 8% of accounts receivable, was it? Let's say my bad debts are going to be 8% of accounts receivable. Could be 8, 9, 10, 5, whatever number you want, of course. But that's how I'm going to do it. So this is the first way I'm going to do it. 8% of accounts receivable. My bad debts are 8% of accounts receivable. What's 8% of accounts receivable? Now the math's a little tougher, isn't it? What's 37,600 times 8%? That's what I want in there, huh? How much is it?
$3,008.
$3,008? Is that what it is? Okay. Yeah. I hereby decree I want a different number. The reason is because it came up too close to last time. Let's make it. Let's say I think these customers maybe are a little shakier. Let's say it's 9%. Okay? Let's make it 9%. What's 9% of 37 cents? So it could be any number, right? How much is it?
3,384.
3,384. Okay, I want this to be 3,384. But you know what? I probably wouldn't use 3,384. Why? Sounds like I made an exact calculation, doesn't it? What I'd probably do is round it to something. What might you round that to? 3,400 would be great. Maybe 3,500. But let's say we want to use 3,400. All I'm saying is, I want to have 3,400 is my estimate of what I'm not going to collect. How much do I think I'm going to collect? 34,200? Everybody staying with me on this? It's not hard, is it? Okay, that's the deal. Okay, good, good. So if I think this number should be 3,400, okay, so now I know what that estimate is, and it's currently 600, what are you going to do to it? Yeah, credit for 2,800. It's just not a big deal, okay? So I'm going to credit allowance for doubtful accounts. Does that sound familiar? Yeah, it's what we did the last time, huh? In the earlier example for the first year. What are you going to debit? Bad debt expense, of course. And it forces my bad debt expense to be 2,800, doesn't it? Right? So if I use that method, where I am estimating based on the accounts receivable, right? If you're taking your estimate as a percent of accounts receivable, you are estimating allowance, right? So I bring the allowance up from 600 to 3,400, and I do that by putting 2,800 in there. That's it. That's 2,800, okay? And then I'm going to debit bad debt expense, credit the allowance. So I end up with 2,800 in bad debt expense. Now I want you to notice something. The allowance is 3,400, right? Bad debt expense is 2,800. They aren't the same except the first year. Okay? Got it? They'll be different. So be careful what you're doing here, right? If I'm estimating based on the receivables, I'm estimating the allowance. Adjust the allowance. Okay, so let's change it now. Okay? Let's change it. Let's say that what we want to do instead is we want to estimate, what did I use before? 3% was it? Let's still use 3% of sales. Okay? It's going to be 3% of credit sales, but all the sales are credit sales this time. So this is an or, right? You can do it one way or the other. You can't do both at the same time. You'll go insane. Okay? So let's do it based on 3% of sales. How do things change, you guys? What happens? Let's get rid of this adjustment. Get rid of this balance down here. Okay? Let's do it again. Let's get rid of this adjustment. Let's get rid of this balance down here. So here we are, exactly the same point. I've got the 600 in here, right? I'm no longer going to be estimating based on accounts receivable. I'm going to be estimating based on sales, aren't I? Okay? My bad debt expense is still 0. My credit sales are 120,000. Everybody got it? Okay? So what do I want to do? If I'm doing 3% of sales, what am I going to do? What do I want to be 3% of sales? Bad debt expense, because that's the portion of sales I'm never going to get, right? So that's what I want the expense to be. That's my estimate. On the income statement. So take 3% there, huh? What's 3% of 120,000? Or 3.6? 3,600? Right? Okay? Everybody agree? 3.6? Okay. All right. 12 times 3 is 36. Yes. Okay, 3.6. Okay, 3,600. What's the balance in there now? Bad debt expense. What's the balance? No. Bad debt expense. Bad debt expense. What does that have in it? It has nothing. I want it to be 3,600. 0. How do you make it be 3,600? It has nothing in it. Debit it for 3,600. Okay, it was too easy, wasn't it? Confused you. Okay, all right, so here we go. Debit bad debt expense. In that case, for the whole 3,600. Got the idea? So I get my bad debt expense to be the number I want it to be. I'd like it to be 3,600. I'm happy. I put that on my income statement. But what does that force me to do? If I debit bad debt expense for 3,600, what do I have to do, you guys? Credit allowance for doubtful accounts. There we go. You got it. For how much? 3,600. I have no choice. Debits have to equal credits, right? So I force that estimate to be what? Now be careful. I'm crediting it for 3,600, and now what's the balance already in the allowance? It's 600. I'm adding 3,600. It'll be 4,200. You're exactly right. And what'll happen? What's going to be the case down here with this method? My accounts receivable will still be what? 37.6. What'll my allowance now be? What did we just make it, you guys? 4,200. Okay. And what does that make my net accounts receivable in my balance sheet? Yeah. 33,400. Is that what that is? Ta-da! If you can do what we just did, like one little piece of it real quick. If you can do what we just did, 10 points on a quiz, maybe 8 at least, 12, 13 points on a test, 12, 13 points on a final. This is how you get points, right? All I'm doing is measuring whether or not you know how to do something. What do you need to do? So you can do it. Right? Does this look hard at this point? Yes. Will it be hard? Well, it doesn't look hard when I do it. When you try to do it. Okay? It's going to drive you crazy. How long will it be hard? I don't know, a couple hours. And then you're going to have it. I'm not kidding. That's what you do. A couple hours on a problem. A couple hours on another problem. A couple hours on another problem. Do it. Okay? Get them wide. Get them wide. Don't wait until the day before the test. Let's do it. It is way too late. Don't even wait until the day before the quiz. Learn how to do this today. And then when you get ready for the quiz, you'll glance at it and say, oh, yeah, I know how to do that. And you don't waste any time. Now it's fresh. We just did it. I showed you. You understand, don't you? You understand? Is it going to show up in your quiz? Yes, if you make it happen, right? Really. Is it going to show up in your work? Better yet, I'm going to give you real money. You bet.
Now, does it really matter which of those strategies we use?
No, it doesn't matter which approach you use. People use either one, or maybe sort of a combination of both, like to make the estimate both ways. And you know, one way I came up with what 3,400 in the allowance, and the other way I came up with 4,200, and I had what 2,800 and 3,600 in bad debt expense between the two. Maybe I split the difference, you know, and make it. Well, let's just say maybe it should be 4,000, right? By estimating both ways. There's other ways you can estimate. You can take your accounts receivable and you can look at the list of accounts receivable and decide who's going to pay you and who's not, based on your judgment. That's a great way to do it, right? But if you have 3,000 customers, that's kind of a pain. If you have 10, you might be pretty good at estimating what's not going to get paid. Another thing you can do, one other thing you can do is you can age them. Let's say I give my customers 30 days to pay. Those that are going to pay me within 30 days, the author showed you this. Those that are going to pay within 30 days, I'm going to collect 99.9% of that maybe, right? Or 98%, or whatever it is, right? And then, so I have a small amount of that that's going to be in allowance. But if it goes over 30 days, all of a sudden they go, oh, wait a minute, they're not paying on time, 5%. If it goes over 60 days, 25%. If it goes over 90 days, 80% I expect never to get. You can do that kind of thing too. Come up with a more sophisticated estimate. And by the way, companies get really, really good at this. They have a really good idea who's not going to pay. And when you're deciding to grant people credit, you know, you're checking out their credit, deciding whether or not you're going to let them buy from you on account, you're kind of determining who's going to pay you and who's not. If I sell to everybody on credit, I'm going to have a lot of assets. And then they have a history of not paying and I sell to them, hopefully I have an incredibly high gross profit margin. What do I mean by that? I buy something for $1, sell it for $100. I have a 99-cent or $99, right, on a $100 sale. I have a $99 gross profit. Everybody who pays me, I make $99 off of it, right? So can I have some not pay me? Yeah, it's all right. Okay, that's okay. I'm only losing, right, the buck that I would have made on, or yeah, the other way. I'm losing $99, but it's not going to be bad. I'm only losing the buck that I had for cost of goods sold, right? But what if I'm buying something for $90 and selling it for $100? Oh, I'm only making 10. If somebody doesn't pay me 100, what happens? They just wiped out 9 sales, is what it would work out to. They wiped out 9 of the sales, right? So I lose a $10 profit on theirs, but I also lose another $90, right? Which I have to sell $900 to get $90 more profit, right? So I mean, just destroying it. So your credit policy is based on what your gross profit margin looks like, who projected customers are, how much people are going to pay you, how many people aren't going to pay you. And we get really good at this. By the way, you can make yourself really popular when you go to work if you end up in a situation where you are responsible collecting the accounts receivable. A lot of companies don't work very hard at collecting them. If somebody's calling you up asking you to pay, you're more likely to pay if they don't. It's just true, right? So if nobody notices that you're late, and you get away with it, what do people do that are going to be late? Or keep being late? What if somebody calls them up and says, well, we can't sell you more product unless you pay on time, and they really need the product? What do? They agree to pay. They'll pay. And those, they might say, well, no, I've never paid on time, and you always deliver product. You can't do that to me now. You're changing the terms. And, yeah, but it says right on there, it's net 30. Right? You're going to pay in 30 days. You can't not pay. It's not okay. We're giving you interest-free borrowing. We want interest then. Oh, no, we don't want to give you interest. Well, then pay us. Right? So, we'll talk about that stuff some more later. Quick.
Question, are you going to ask us to just make up a percentage?
Oh, no, I wouldn't do that. Oh, just straightforward. I'll tell you what the sales were. I'll tell you what the cash receipts were. I'll tell you what the bad debt experience was. The ones we're going to give up on, right? I'll tell you what percent to use. I'll probably give you problems we have both. And the examples in the quiz that I gave you and the test I gave you, where you have both the percent of receivables and the percent of sales. You'll get some practice. So I'll give you that information. In real life, you have to estimate. Absolutely. That's hard.
Do companies just stop working with other companies that don't pay on time? I don't understand.
Well, you'd like to, but let's if they're 90% of your sales, you just try to get them to pay on time and you don't want them to go away. Or you negotiate different terms with them, right? Give them more time to pay, do something, yeah. But yes, we try not to sell to people who aren't going to follow their agreement with us, right?
Why is it acceptable that we're like, okay, we're gonna just not worry about all this money?
It's not.
Yeah, but why do they?
I think it's unethical on the part of the business that doesn't pay on time. Absolutely. If somebody buys something from you and they're in business and they hit a hard time and can't pay, that's a legitimate bad debt. I mean, you take risks. When you sell to somebody on credit, they could go bankrupt and not be able to pay. Would you agree with that? And they're not unethical because they went broke. Maybe they were inept, but maybe not even that. Maybe they weren't incompetent. They just got unlucky and they went broke, right? Things turned against them and it didn't work. Another competitor came in or the economy changes or something, right? But if somebody buys from you knowing they're not going to pay you, they're just stealing from you. Do people do that? Do people buy things knowing they're not going to pay? Of course. Every time you go to a store and you buy something, if they grant credit to anybody, you get to pay more for the people who don't pay. It's the same thing with people who don't pay their taxes. Who pays their taxes? Those of us who do pay. We pay theirs. They're stealing from us. If your friends ever brag to you about not paying taxes on something, thank them for stealing from you. It's great. You want me to just give you the money instead of you just stealing it that way? Give me a break. I always tell them I'm a CPA, I'm turning into the IRS, I'm ethically bound, I'm lying. I'm ethically bound not to turn into the IRS, actually, right? But I tell them that. Geez, you're cheating on your taxes. I got to call the IRS and tell them. That's a direct line, I'm a CPA. I was going to show you one more thing. I have 2 minutes. Let me do one more thing. This is easy. What happens if one of the accounts that we wrote off, remember the write-off journal entry? There it is right there. I debited the allowance for doubtful accounts and credit accounts receivable because I'm giving up, right? Let's say 500 of that got paid. Let's say a customer calls me up and says, we've reorganized. We were in bankruptcy. We've reorganized, and now we are going to send you your $500. I'm going to send it to you in a month, okay, when everything's done. What would we do? I just realized I should not have written off 500 of that. It's real simple. What do you do to reinstate the account, you guys? This is easy. What do you do to reinstate the account here? How about putting it back into accounts receivable, seeing as they now owe it to you again? You like it? So let's debit accounts receivable. Excellent. So this is simple. Sounds like it'd be hard, but it's not. And guess what? I thought I had found 2,400, but I only found 1,900. What should I do? Put 500 back into the allowance. That's it. Wow. And we move forward, right? That's it. That's how you reinstate an account. One more thing. What do I do now when they pay me? Of course. Debit cash, 500. Credit what? Accounts receivable, 500. Of course, you know that. And one more thing. What if they just send me the money, they don't tell me they're gonna send it to me? Don't bother with this or with this. Debit cash, credit allowance for doubtful accounts is just fine, right? Because they gave it to you, and you don't need to put it back in your receipt. See you guys. Thanks for showing up today. Keep working. It's gonna pay off big time. We are all gonna be really, really happy after the next quiz. All smiles.
I was wondering, do you have our list? You are set. You heard about this one, you should, work, quick work, and,
How many credits do you take?
15.
Don't drop. That's the point. You gotta get it going. Thanks.